Good afternoon. I'm delighted to welcome you to our webinar entitled Gear Shift for European Equity Markets. What will it take to make Europe a leader? My name is Pete Tomlinson. I'm Head of Equities Trading and Post-Trade at AFME, the Association for Financial Markets in Europe. The title of the webinar is also the title of a new report which has been published this morning by AFME in collaboration with PwC Strategy and European markets are at an inflection point. There's an opportunity and indeed a renewed appetite to reinvigorate primary and secondary markets, to capture a greater share of global investment capital, and to make markets more efficient, more harmonized, easier to navigate, and more attractive to global investors. This comes at a sort of timely moment, particularly timely in the UK, with the Financial Services Growth and Competitiveness Strategy to be announced tonight at Mansion House, or indeed some of the parts of it we're seeing published already. And from an EU perspective, with the recent consultation on the Savings and Investment Union and what's described as an ambitious package of legislative proposals expected by the end of this year. So our report is the result of a number of structured interviews with equity market participants from across the value chain, so including issuers, intermediaries, and investors, as well as in-depth qualitative analysis by the PwC team. Over the course of the next 40 minutes or so, we hope to explain a bit more about what the report tells us about primary and secondary equity markets in Europe. Where do we go from here, and to hear directly from market practitioners about their own experience. Little bit of housekeeping. Please feel free to ask any questions using the Q&A function in Zoom. We're going to try our best to address them as we go, if not to take them at the end of the session. So I should probably introduce now my panelists. I'm delighted to be joined by Dr. Philip Wakkerbeek, Global Head of Financial Services at PwC Strategy and who joins us from Germany. We have from Brussels, Julio Suarez, Head of Research at AFME, and from London, Sam Ward, who's Head of European Equity Capital Markets at Capital Group. So thank you very much to all three of you for joining me this afternoon. Philip, I would firstly like to hand over to you as one of the principal authors of the report to maybe tell us a little bit more about the key recommendations and findings. So Philip, over to you.
Perfect. Thank you very much, Pete, and for setting the scene and for having us here on this call. So let's jump right into it. When we started our research almost a year ago, with a lot of quantitative analysis and a series of in-depth interviews, I will share with you in a second the methodology we used. It was still a bit of a different timing compared to now, and there's a lot more momentum for the European market based on a set of relevant developments. So starting point on page 2 of our analysis is a comparison of the status quo from a maybe more macroeconomic perspective, because when you look at the size of the economy in terms of real GDP and we compare the US and Europe for us is the European Union, Switzerland, and the UK for sake of data availability and efficiency of the analysis, the economy is more or less the same size. We talk about a 19 trillion euro economy. But there's a major deviation when we come to the depth of the equity markets, where in the US it's 61 trillion almost. That's 3.2 times the real GDP, while Europe is lagging behind quite substantially. It's only 80% of the GDP with 15 trillion. So it shows there's a lot more potential in Europe, and we're going to investigate how to release the full power of this potential. On page 3, we actually looked also at the IPO activity, both in terms of number of transactions and volume over the last 14-15 years. Similar picture, you see that there are a lot more IPOs taking place in the US with higher values. I think what is also important to know is that to note that 70% of those IPOs in Europe are smaller, up to 100 million in individual volume and ticket size, While flipping that around in the US, you see that almost 60% are between 100 and 500 million, and substantial number is also beyond $500 million, which also is an indication of a different composition of what is IPO'd in Europe and what is IPO'd in the US. When we go to page 4, we also looked at the drivers that now can influence a change, and we perceive there is a very good momentum for European equity markets at this point in time, and the picture has quite substantially changed, I would say, over the last 6 months or so. It was different, as I initially said, when we started with the research on the back of a couple of very important developments. And you see here the 4 key drivers influencing that situation and driving that momentum for Europe. One is obviously on the regulatory side, the firm intention of the European Commission to drive the Savings and Investment Union, to accelerate the efforts to integrate capital markets better and mobilize private investment, which is very important, as you will see later on as part of our analysis. Then the transatlantic instability and the more difficult relationship and the less stable outlook for the US as a partner is also impacting investment behavior and transatlantic collaboration in the favor of Europe at the moment. We continue clockwise. You see that there's also renewed European unity with a stronger political will to drive integration that is more needed to strengthen Europe as a whole, and especially also as a capital market. And there are obviously a lot of geopolitical pressures, as you very well know, with the recent developments that further stimulate those developments. So there's a positive momentum. Pete, you mentioned already in the beginning that the report comes timely, also based on the developments we see both in the UK, but also in the European Union. And let's move to page 5, where I give you a bit of a context what we've done in our analysis. So we put together both a very quantitative assessment, simulation, and modeling exercise to estimate the potential of how Europe can close the gap to the US in terms of both primary and secondary market performance. But we also conducted a series of 40+ interviews with a broad set of interviewees representing all the relevant institutions that will contribute to drive the prosperity of European equity markets, ranging from European issuers that listed in the US, and European issuers that listed in the EU or UK. That includes also companies that have contemplated to list either in Europe or the US and then decided for another one. And we investigate the reason why that was the case, but we also look at electronic liquidity providers, investment banks on the ECM side, on the trading side, on the research side, various types of investors, the major exchanges, index providers, but also very importantly, private equity firms and venture capitalists as a key driver for IPO activity. And combining those in-depth interviews and the insights we generated with a quantitative analysis led to the recommendations of our report. When we look first into some of the interesting data, and you see this on page 6 of the presentation, the one area we particularly looked into was cross-border listings that have been a one-way street. And when I say cross-border listings, that means European companies that have deliberately listed in the US or potentially the other way around. But you see that the number of European firms that have decided to list in the US is significantly larger than the other way around. And there's hardly any US firms that solely list in Europe. It's maybe dual listings, but on the European side, there are really a number of companies that have intentionally decided to list in the US and in the US only. Yeah? And the US listings makes up already 10% of the total European listings. So on the left-hand side, you see the number of IPOs over the last 14 years. White is US, and red is listing in Europe. And when you move, very interestingly, also on the right-hand side, and you look at the performance, the post-IPO performance of all those companies that floated in that respective time period, you see that for the European firms that listed in the US, initially the performance was better at first close date and in the beginning of the listing, but until to date, yeah, the performance is weaker than for the ones that listed in Europe. Yeah? So there seems to be some difference in the initial perception of those IPOs. If you IPO in the US, you initially have potentially a better impact, but in the long run, Europe seems to be a better place. On average, aggregated across all the companies, and then there are obviously a lot of nuances in the details we can also discuss. There are certain industries that clearly have a stronger notion to list in the US. That includes, for example, technology companies, life science companies, or certain pockets of consumer business models that are technology driven and more scalable. The reason for that is largely that you have a deeper pool of both analyst coverage, but also investors that with a particular understanding of those industry sectors. While for most of the other industry sectors, Europe has been a primary destination for IPO activity, and it paid out well for those companies who decided to go that route. When we move to page 7, we came up, based on the analysis, with 4 key areas of recommendations. There are more detailed recommendations behind that, but we can group them into 4 areas that are needed in order to further enhance the attractiveness of European equity markets. And the first bucket, and the most important bucket, is obviously to grow investment demand and grow investor demand, particularly among retail investors. There are, depending on the scenarios we look into, between 200 and 500 billion annually of new investment flows into equity markets can be developed, and that would obviously have a major impact on deepening the market and the liquidity in Europe. Second area of action is to address market structure frictions. There are certain liquidity barriers through passive indexing reforms, liquidity enhancement tools, lower post-trade costs, and a couple of related technical elements that can be addressed to increase the efficiency also of the European equity markets. The third bucket is really to boost growth of European corporates, because we've seen that one of the key growth areas of the US market versus the European market is the underlying growth in productivity of the US corporate sector. And that has largely something to do also with the adoption of technology and driving tech-related business models and companies that have attracted investor funds from all over the world into the US. And I think that Europe needs to develop also a more strategic approach, what sectors could be attracting those investor demands, complementing what the US and China do on the core technology side. It could be green technology, could be other areas, but there are clearly pockets where Europe can be ahead of the curve and really attract international investor demand. And then obviously there's a fourth bucket around strengthen the regulatory framework. We mentioned already some in the beginning, but I think this is also very much needed and supportive of the future growth of the industry. And with that, I'm leave it with that for the moment and hand over back to you, Pete, for the next part.
Thank you very much, Philip. And maybe we'll come back to point 1 a little bit later on. But I'd certainly encourage anyone to sort of download and read the report for more detail on those recommendations and those insights. Sam, I'd like to bring you in at this stage. The report, as Philip's explained, shows the increasing difficulty that Europe has had in attracting IPOs. although obviously going to the US hasn't always been the holy grail for issuers and hasn't always delivered the results that they may have expected. How does Europe kind of dig ourselves out of this hole? What do we need to do to improve competitiveness?
Yeah, thank you. It's a great question, and it's probably one that could take a week to answer. So perhaps I'll just pick on a couple of points. I mean, the ones that have been well discussed, I think, are the ability for European companies to raise capital, executive pay, the depth of capital markets in Europe, and regulation. But I think one of the interesting topics for me is probably Europe needs to scale up. We need to have larger companies here. And what does that look like in practice? Well, if you look at the statistics, the Magnificent Seven in the US spend more on R&D than every European listed company combined. And I think that needs to change. That's not a sustainable situation. So we need to create a situation where Europe is a center for innovation, for attracting and retaining talent, and for building scale. And that applies to both private and public markets. I think there's also an argument to be made that Europe needs a deeper pool of venture and early stage capital. I think all too often we see young European companies having to or deciding to go to Silicon Valley to get their growth capital, and ultimately they tend to become US companies and list in the US. So I think there's a broad point there around scaling up. I think there's also a cultural point. I mean, from an investor perspective, I think in Europe we see that IPOs are all too often thought about as an end goal. And actually, an IPO is, I like to think about it as it's the beginning of the life of a public company. And it's really crucial to get the IPO right. And I think all too often we see this focus on short-term value maximization in IPOs, and actually not focusing on getting the right shareholder register, building the right long-term incentives into their management plan, and making sure that the shares get off to the right trajectory, because that's really the key for follow-on problems around liquidity or ease of raising capital in future. That a lot of that boils down to getting the shares moving in the right direction immediately after the IPO. And then just thirdly, and Philip alluded to this as well, is I think in Europe we have a culture of kind of saving rather than investing. The last statistic I saw recently was we have more than 11 billion euros in cash and cash reserves in Europe, which I think is about a third of private wealth. So how do we mobilize that to improve returns for those people, and also create the demand that would come from that?
Thanks, Sam. Just to, maybe follow up on something that you said there. So the report is mostly a sort of comparative analysis of public markets in different jurisdictions, but maybe there's an elephant in the room that we've sort of ignored a bit. So private equity, do you see that as maybe a bigger risk to European public equity markets, is the fact that many companies are choosing to stay private for longer?
It's a huge elephant in the room. So I think, every day you go into the financial press and there's a story about a European company moving to the US. They're listing to the US, and this isn't to say that's not a problem. Like in the last decade, I think we've seen 130 European companies move to the US for a total value of just under $700 billion. And that's a big figure and a big problem, and not to downplay that. But when you look at the number of companies that have moved from European public markets into private markets in the last decade, it's 1,000. And the value is around about $1 trillion. So private markets are a much bigger problem than companies deciding to move to the US. I think also let's put it into perspective. The size of the US public market in 1995 was, I think there were 7,600 public companies. And today it's more like 4,300. So they're having the same problem as to the rise of private markets. I think in Europe, we often think about the US as being this panacea. And actually, many of the problems that we have in Europe are also faced by US companies. US companies' annual report has increased in length by nearly 50% in the last 5 years. So we hear many of our US companies that we're invested in raise the same problems as European companies. And this depth of private markets is allowing companies to stay private for longer. Yeah, I think if we rewind kind of 20 years, companies like OpenAI, SpaceX, Stripe, they would probably be public companies by now. But there is an alternative. I think that's a much bigger problem than the kind of theme of moving to the US.
That's super interesting. Thank you, Sam. As Philip alluded to, we sort of started this research process last year, and you know, the numbers and the sentiment might have moved on since then. It's certainly fair to say that 2025 has not been a quiet year in equity markets. So Julio, bringing you in at this point, what sort of trends have we seen in the first half of the year in 2025?
Thanks, Pete, and good afternoon, everyone. And well, indeed, the first half of the year has been quite eventful for primary and secondary markets in Europe. We can perhaps start with a recount of the evolution of equity prices and kind of the basics of what we have observed in the first half of the year. What we saw is that, well, effectively, European shares rose quite significantly or in the first quarter of the year, while US stock prices lagged behind a little bit in the first quarter and kind of caught up in the second quarter of the year. However, once you compare in dollars, both the European and the US performance, which is kind of perhaps of relevance for global investors, you can see a gap between Europe and the US in terms of on a total return basis, with the stock 600 gaining about 25% on a total return once accounted in dollars. Now, this of course considers the large depreciation of the dollar against the euro and many other kind of macroeconomic kind of developments, but there's a clear divergence, which some investors kind of have attributed as a European, some sort of European renaissance. And well, you're the expert here, Sam, but well, some investors have. I'm very happy to hear what's your take on this. But yeah, some investors have mentioned that some factors such as inflation expectations kind of in control, announcements about government, the German government, kind of budget considerations and the budget boost in Germany, and kind of a more general kind of political consensus around economic policies in Europe, which seems to kind of also be driving this. One kind of the interesting data point is the net inflows into European ETFs, which are expected to reach a record high in 2025. Well, this kind of based on Lipper data. If we go to the next slide, kind of looking in more detail about looking at the valuations and kind of a comparison on company valuations between the US and Europe, we see that, well, regardless of the political and the economic cycle events, there's still some degree of a structural gap between US and European company valuations. Certainly, well, the US continues to exceed the higher valuations due to various multiple factors. A lot has been written about the competitiveness gap, where you measure that as total factor productivity, GDP per head, or the degree of of interconnectedness or the degree of integration between the European bloc and also within the US bloc. So certainly there's a gap that the European market kind of acknowledges. There's of course what Sam was mentioning on the massive contribution of the Magnificent Seven on US market cap, which is quite not minor, around 34% of market cap, and the broader kind of contribution of tech that is still there. But more structurally, it does give the impression that well, US companies' profitability seem to be kind of structurally higher by around 2 percentage points compared to European companies. Now, an area where we have not seen necessarily a European renaissance, if you like, perhaps if we go to the next slide, is in the area of IPOs. So from an equity raising perspective, we saw that following the peak levels during the COVID period, and and this is quite well covered in the PwC report. We saw kind of peak levels of company IPOs during the COVID period. But most recently, we see that actually IPOs are even below those that we observed prior to the COVID period. So that's certainly some area that is continues to be kind of concern, more from a broader perspective on the functioning of the European IPO market. If we go to the following page, and was kind of compared with global competitors, and here just even looking at the latest numbers at the second quarter of this year, we see that European IPOs stood behind what we observed in other global compared with other global competitors such as the US, China, Australia, and India. So that's in itself we used to kind of run some comparisons only with the US, but we need to kind of start looking this in a broader picture, and the fact that there is some similarities between Europe and the US in terms of GDP, and there are certainly some gaps in terms of the European capital markets against the US capital markets. But then there's perhaps another layer of concern going forward, which is kind of other global competitors beyond the US. Perhaps if we look at more into the details of the national IPO numbers in the next slide, we see that one of the concerns is effectively some degree of national IPO silos. So if we look only at the IPOs in the first half of the year, we saw that Nasdaq Stockholm effectively led in national IPO proceeds, followed by Madrid and Warsaw. The FT, the Financial Times, noted recently how London IPO's fundraising had hit a 30-year low in the second quarter of the year. And that's certainly quite an element of concern. But I think looking perhaps at the bigger picture, Sweden has been frequently highlighted as a star national case. If one's looking perhaps only at the EU, and the PwC report also has an interesting box on it. The OECD and SEPs have commented on this as well. But perhaps there are some issues kind of that drove our attention, which is the fact that the large majority of Swedish IPOs are generally domestic. Perhaps a bit obvious, but Spotify, a national company, Pride in Sweden is listed in the US and not in Sweden. So I think this kind of underscores one of the elements that Sam was alluding to, which is perhaps a lack of a regional champion and a lack of a more vibrant IPO market, but perhaps on a more pan-European basis. Perhaps if we go to the next slide, and another topical event, and the PwC report comments this on quite important level of detail, and how it's not always guaranteed that European companies will do better when they kind of list in the US from a price return perspective. And a lot has been written on this. I just wanted to provide some kind of some additional numbers of comparison, which is on the issue of analyst coverage for companies in Europe and in the US. Here, looking at a topical event, which is on how Wise announced this year the eventual shifting to the US. Its primary listing from London to the US, and a lot has been commented on this. I wanted to mention also the issue about the analyst coverage, the fact that US tech companies get around, on a median basis, around 30 analysts per share. That certainly is quite significantly above from what we have observed for Wise as a standalone company. And when we compare with other companies that have recently shifted from London to the US, it's a bit of a 50-50 case. In some cases, we have seen an increase in analyst coverage. In other cases, is a bit more of a nuanced approach. But certainly this is an element that continues to be of relevance once looking perhaps more generally at the IPO ecosystem, at the equity market ecosystem. Now, to finalize, if we go to the next slide, and perhaps moving from the primary markets now into the evolution of secondary markets and evolution of market liquidity in Europe, we have observed a substantial increase in trading activity in the first half of the year, particularly in the first quarter of the year. Most recently, trading activity adjusted by market cap, which is the turnover ratio, which you see on the right-hand chart. We have observed an interesting reversal of a multi-annual declining trend in turnover ratio, which is a positive aspect. It's an interesting development that we will continue to keep track of. Now, it's undeniable that there are also some geopolitical events behind this, and kind of also global investors reallocating their portfolio preferences and their taking decisions from a risk management perspective, which leads me to the last slide. And I don't want to get too technical here, but with these general kind of global events and these quite eventful market announcements that we observed in the US, quite visibly the US tariffs announcement, we did observe an increase in lead trading activity, so on venue lead trading activity, and we saw an important increase just following the US tariffs announcement, but it's something that we have observed during other previous events of high market volatility, which kind of illustrates that, during periods of high market stress, there's a preference for quick execution regardless of price impact. And there is a continued preference for, investors and market participants to make use of some degree of flexibility, on whether if it's lead trading or it's dark trading or if it's OTC in whatever shape or form, to execute on whatever is most convenient for market participants. Sometimes, I don't want to caricaturize here, but sometimes people say, lead is good, dark is bad, but it's kind of, I think it's, from my perspective, it's kind of oversimplifying the issue. And I think my message here is that has been some interesting flexibility on how people are trading on the market, and how traders sometimes prefer, fast execution using lead venues and sometimes other forms or other shapes for trading. So that's perhaps what we have seen. And to conclude, Pete, effectively, some interesting numbers in ETF inflows, as I said, interesting developments in equity trading activity, and perhaps some continued element of concern regarding the IPO evolution.
Thank you very much, Julio. Like you say, certainly some interesting data and some positive data, some positive signs for Europe in there for sure. Sam, bringing you back in, have you, from your desk, observed this sort of rotation of capital inflows towards Europe in the first half of the year? Is it something you see as temporary or permanent, and sort of what do we need to do to make it stick?
Yeah, it's a good question. I mean, world trade dynamics have fundamentally shifted in the past 6 months. And this is coming at a time when the US equity market accounts for, I think, about 66% of global equity markets. That's an all-time high. Long-term average is about 48%. And that 66% equates to about 26% of global GDP. So there's an argument to be made that the US market, in terms of proportion relative to world equity markets, is at all-time highs by a very wide margin, at the same time as world trade dynamics are fundamentally shifting. Now, the US markets have outperformed Europe, I think, every year since 2005, and that's I guess a scary statistic. But in the 15 years prior to 2005, Europe actually outperformed the US. And these things typically do go in cycles, although the current cycle is probably longer than I think we've seen before. So I guess what I'm saying is, US at 66% today, I don't think anyone expects it to go back to 48% or anything close to that. But if Europe creeps up a few percent, and perhaps the US settles at 63% or something, that could trigger very substantial inflows into Europe. We have seen some early signs of that this year. There's a Bank of America fund manager survey recently that indicated there was around $50 billion of inflows into European funds year to date. But that's quite small in the context of, I think, more than $520 billion of outflows from European funds since 2005. So I guess it's cautious optimism that things are moving in the right direction, but it's a bit too early to say if that sticks.
Fair enough. Thank you very much, Sam. Philip, I guess one way to make it stick for sure would be changing that cultural aspect that Sam mentioned earlier and growing retail participation in Europe. That was certainly one of the key conclusions of the report. So the sort of potentially transformational impact of that is really quite striking and could go a long way to addressing some of the sort of perceived funding gaps that, for instance, Mario Draghi identified in terms of what the EU in particular needs to do to strengthen itself. Can you walk us through in a bit more detail the model that was developed in the report and what the key conclusions of that were about the potential impact of retail participation?
Yeah, absolutely. And thanks for bringing the topic up in the various discussions earlier. I think the key theme is indeed that there is a lot of capital in Europe. There's a lot of capital available, but it's not channeled in the right sources from our perspective here. And if we are able to unlock that potential, then this can be quite substantial. And you remember that slide from earlier on. So our first really important and biggest lever was to increase the investor demand, particularly among European retail investors. That could lead, depending on the scenario, to additional inflows of 200 to almost 500 billion euro per year. And on the next two slides, I'm going to lead you through a few of our assumptions we've made to run those simulations. So on page 17, you can see that we have basically looked at three different scenarios. One is a baseline scenario. We've taken a bit more of an optimistic scenario and a scenario that is very optimistic in terms of the different ingredients of that. And we called it Prosperity Plus. At the end, it's all about creating a pan-European equity-driven pension system that allows for additional sponsorship or some sort of support, may it be certain tax advantages or other benefits comparable, like a 401k in the US or similar instruments we've seen that have been implemented very successfully in Sweden and some other European countries. And you remember that Sweden came up a few times in our discussion earlier as a very good practice on how you can drive equity market deepening and the liquidity. So to model those scenarios, we look at three major components. One is the demographics. So how basically, what is the relevant part of the workforce that would benefit from such a system? What is the investment propensity? So the expected share of the individual participating, and then we modeled that based on a baseline rate and additional sensitivities to GDP and funding status. And we also looked at the contributions. So what is the individual contribution per person per year, and some temporal progression that we modeled also. When we go to page 18, I'm going to show you a few numbers. So this is where we end up with the 190 to almost 500 billion. And I think the benefit is that it's really aimed at increasing the participation of the wider workforce in a instrument that is where also different instruments have been discussed. And in the baseline scenario, the assumption is that assuming constant demographics, a fairly conservative investment propensity of 30%, assuming that this is really also some sort of government endorsed or sponsored, either with tax benefits or other types of support, that is relatively low compared to well-functioning systems like in the US or in Sweden, where we will end up in a propensity at the moment of about 50%. We assume annual contribution of 2,800 or 230 euros per month, which is 7% of the average EU gross salary. That is also lower than some of the proposals that have been on the table. Like some of you may remember, the former German finance minister Christian Lindner suggested an Aktienrente, what he called, which is a stock pension type of instruments, 3,600 euros. So we only go with 2.8 and end up, when you multiply it all out with those conservative assumptions, at 190 billion. I think what is important is that we need to include some restrictions on where the money is invested, so that not all the money flows into the Magnificent Seven, but it's also invested into Europe. That is obviously a precondition of that. And then obviously we increase the individual levers across the different scenarios. So we slightly increase the investment propensity to 35%, the annual contribution to 3,200, and then even further in the Prosperity Plus. I think all scenarios, even the most optimistic scenario, is in terms of individual parameters below the levels that we have achieved already in the US and partially in Sweden. That shows how big the potential is, how much money could be made available if channeled in the right direction, and if the right supporting mechanisms are there. And I think that would be something where we, on the back of the Savings and Investment Union, see a lot of additional momentum. If we were able to realize that potential, and we can run such a system for a couple of years. We've also done some simulations that the total cumulative retail contribution, and you see that on the next page, I believe, page 19, could reach in the different scenarios until for the next 20 years, a total contribution of between 4 trillion and 9.5 trillion, which would bring us more or less in the Prosperity Plus scenario to the level that the US has reached today. So it's not overly aggressive. It's not totally over optimistic. There's a spectrum, but even if we were just to land on the baseline balance, that would substantially increase the means and the investment power put into European equities, and should drive also many of the other targets that have been issued in recent reports, like the Draghi report that you mentioned, Pete, and other initiatives that are desperately needed in Europe.
Thank you, Philip. Very quickly, Julio, I'm going to come to you for sort of one final question, which is maybe a bit more crystal ball gazing. So we're starting to see some interesting experimentation with new technologies and with tokenization coming to equity markets. Could you maybe tell us a little bit more about that and what the future might look like?
Indeed, and this is an interesting development, and from a European perspective. So following a number of central bank DLT trials, we have seen that the momentum of tokenization has continued, and more specifically under the EU DLT pilot regime, we have seen some increasing appetite from micro participants and infrastructure providers to effectively kind of participate in this ecosystem. So we are aware of three various infrastructure providers, CSD Prague, 21X, and 360X, that have been just recently authorized to participate and offer their services either as settlement services or or also as securities trading of shares or debt securities from on a tokenized kind of or perspective. So it's an interesting development. It's an area that has been growing over the last few years. We have a report that looks at this in more detail, and people can look at it on our website. And another interesting development specific to the equity market is also recent announcement by Robinhood and Kraken to retail trading kind of infrastructures, announcing that they are facilitating the trading of U.S. public trades or public shares in a tokenized format for European investors. So that's an interesting development, and their expectation is that later on the potential is to also offer trading of private companies on a tokenized format. So that's quite a promising one. There are certainly some appetite for market participants and various infrastructure providers in this quite a fastly growing area.
Thank you very much, Julio. I'm afraid that's all we have time for this afternoon. So all that's left to be said is a huge thank you to you, Julio, to you, Philip, and to you, Sam, for joining us and sharing your thoughts on these topics. Hopefully, for those of you who've joined us online, this has been a useful and educational session. You will receive a link to the report after the session if you'd like to do some further reading. And please also feel free to reach out to any of us if you'd like to discuss anything we've talked about further. So thanks again to my panelists. Thanks again to everyone for joining this afternoon, and speak to you soon. Goodbye.